Hi everyone, I'm Sabrina.
And I'm Jonathan. We are the lawyers at Verity Law.
Recently, many clients did their corporate estate planning with us. This means they're trying to pass down their companies in a simple, secure, and tax-efficient way.
While we're not accountants, we can offer business owners valuable advice on corporate ownership, succession, and probate tax planning. We often work with accountants who help with income tax planning.
First, let's dive into corporate ownership. As mentioned in our previous videos, a common misunderstanding is that the articles of incorporation is enough to show who owns the corporation. And since this information is registered with the government, you don't need to worry.
Actually, the articles show who manages the corporation, also known as the directors. For the most part, the government wants to keep shareholder information private. For Ontario corporations, they don't allow shareholders' names to be registered. If you take a look at your articles, you won't see a line that lists who the shareholders are.
Exactly. To find this information, you need to have a private document called Corporate Minute Book. This is not registered and is usually created by your business lawyer. It contains important information as to who are the shareholders, how many shares they hold, and what types of share they hold. For example, it could show that John Smith is the shareholder who holds 100 common shares.
The Minute Book also contains important bylaws, such as whether a single director can authorize the corporation to get a loan from a bank.
Yes, it is a very important document that should be fully explained by your lawyer. You don't want to just select the default answer to all the questions. For example, when asked if there are share transfer restrictions, many business owners will select none because that is the default answer.
However, this can have serious consequences. Imagine there are two shareholders, Amy and Bob. If there are no share transfer restrictions, then Amy can sell her shares to Cindy, who is a stranger to Bob. Then Bob would need to manage the company with Cindy, a total stranger to him.
For sure. To avoid this type of situation, share transfer restrictions should be set. Amy and Bob can choose a clause that requires a majority of shareholders to agree before shares can be transferred. If this ends up causing a stalemate, then a shareholder agreement should be made where it can state that the shares for sale must be first offered to existing shareholders. Only when existing shareholders refuse to purchase, then it can be offered to outside strangers.
Many clients have asked us if share transfer restrictions apply when we pass and our beneficiaries are to inherit the shares. It indeed does. So if Bob wants to pass down his shares to his daughter, but there are share transfer restrictions stating that he's not allowed to do so unless Amy also agrees, then Bob won't get to do what he wants.
In that case, when drafting Bob's personal and corporate will, we will also examine his articles and update it if possible. We can amend the articles and create a shareholder agreement that will prohibit Bob from selling his shares to outside strangers, but allow him to pass it down to his children.
Or we can say in the agreement that the corporation or its existing shareholders must buy back Bob's shares when he passes. So his children would get cash instead of ownership to the corporation. This is often a popular choice with our clients. While Amy wants to work with Bob, she may not want to work with his children.
Now, the two options John just mentioned are completely different. If the corporation buys back Bob's shares, this means that the total amount of share issued is reduced. So let's say the corporation issued 100 shares, and Amy, Bob, and Cindy each owned 33 shares, meaning they are each 33% shareholders. If the corporation buys back Bob's shares, then the total issued shares become reduced to 66 shares. Amy and Cindy are now each 50% shareholders, while still each holding 33 shares. On the other hand, if Amy buys back Bob's shares personally, then she is the 66% shareholder, while Cindy remains the 33% shareholder.
Now, if Amy buys back Bob's shares personally, then she pays for them from her personal funds. If the corporation buys back Bob's shares, then the company pays for it from the business account.
Since we cannot predict when a shareholder will pass, the corporation or any existing shareholders may not have enough money to buy back all of their shares. In those cases, having corporate life insurance is an option, since the insurance proceeds are usually paid to the corporation within 1 to 2 weeks of the shareholder's passing.
Since the insurance proceeds are paid to the corporation, be mindful of this if you want to close down the corporation within your lifetime. It can be a big problem if the insurance can only be paid to the corporation, but the corporation no longer exists when the shareholder passes.
For sure. On the other hand, if you wish to keep the corporation indefinitely, it can be a great tool for estate planning.
Exactly, because a corporation would not end even with the passing of a shareholder. It can exist as long as there's still at least one director and one shareholder left. However, unlike personal funds, there's no such thing as a joint bank account for corporations.
This means even if you have more than one signing officers to the corporate bank account who are all authorized to make deposits and withdrawals, this does not make the corporate bank account a joint account. When one of the signing officers pass, the business bank account is not automatically transferred to the surviving signing officers. Instead, the bank will ask for a secondary will, or if there's no will, then probate approval from the court.
A secondary will is a will that is separate from the personal will. Its full name is secondary will not subject to probate. This means that the corporate lawyer can take instructions from the will and transfer the shares to the beneficiaries without court approval. So, this can be done much faster. A corporate lawyer can transfer the shares within 1 to 2 weeks of the shareholder's passing instead of having to wait for court approval, which can take 6 months to a couple of years.
Also, since having a secondary will means no court involvement is required, the corporate assets are not subject to probate taxes when passing down. Probate tax is 1.5% of the total estate value, with the first $50,000 being tax exempt. So John, what type of assets can be included in the corporate will?
Only assets that are owned by the corporation, including its business bank account, corporate shares, as well as any real estate or vehicles under the company's name. Moreover, any vehicles under the deceased personal name can also be included in the secondary will and would also be tax exempt.
When drafting the corporate will, your lawyer should ask to see if you have a complete and updated corporate minute book, and your ownership of the corporation must be proven when you pass.
Also, your lawyer can do a review to see if your corporation indeed owns the assets you are listing in the will. We had past clients where the client thought that their office, vehicle, and certain investments were owned by the corporation, but then it turned out it was actually owned by them personally. That was definitely a nasty surprise for them.
Yes, the general rule is that you cannot give what you do not own. In this case, the shareholders cannot pass down what the corporation does not own in a corporate will, even if it's written in there.
Lastly, we will address the popular topic of professional corporations, such as law firms, dental offices, family doctors, and accounting firms.
Those professional corporations each have their own regulatory agencies. For instance, Ontario law firms are regulated by the Law Society of Ontario, which requires all shareholders of the law firm be licensed lawyers.
This means that if your children are not lawyers, but you intend to leave the law firm to them, then it would create many complications.
Your children would need to convert the law firm into a regular company or shut it down and cash it out.
The shutting down process of a professional company is a lot more complicated than a normal company. Your corporate executor must communicate with regulatory agencies and figure out exact steps. For instance, a law firm shutting down would require your executor to return all money held in trust to the correct clients. Any urgent files would also need to immediately be transferred to other lawyers.
So it's always ideal if you can select a fellow professional to be the corporate executor, and then your non-professional children can be the beneficiaries. So perhaps your lawyer coworker can wind up the law firm and cash it out, and then your beneficiary children can just receive the retained earnings in the law firm.
Although there won't be the 1.5% probate tax when there is a secondary will, there may be income taxes when your children inherit the company. Using the earlier example, if your children take the retained earnings out of the corporation and add it to their taxable income for the year, this could result in big tax consequences.
Alternatively, your children can leave those earnings in the corporation and give it to themselves as a salary or dividend gradually, year by year, to reduce tax consequences. The corporation doesn't end because a shareholder passes away. Your children will have the option to keep or sell the corporation when they receive it.
However, if the corporation is a professional corporation and your children are not professionals, then they need to convert it into a normal company before they can keep it, as mentioned earlier.
Even if the corporation is a normal operating company, your children may not want to continue operating it. In Canada, doing business is a lot of work. You need to bring in clients and maintain cash flow, manage employees, find suppliers, build partnerships, routinely deal with the government and CRA.
So most children may see the company as more of a burden than a blessing. Many of our clients simply choose to cash it out despite the tax consequences.
Another option is only leaving holding companies to your children, or have your children convert the operating company to a holding company. Holding companies have no active business activities and are just used to hold funds and invest them. This way, your children can enjoy the benefit of getting retained earnings gradually without having the burden of managing an active business.
However, while probate taxes can be avoided with a secondary will and income taxes can be deferred with a holding company, the passing down of corporate shares may result in tax consequences. For this topic, please consult your accountant or financial planner.
All right, let's do a summary. There are 3 main points when it comes to passing down your corporation. First, do you own the corporation and its assets? Ensure your lawyer checks your articles of incorporation, corporate minute book, and your business asset ownership documents, such as the deed to your office.
Second, are you authorized to pass down your corporation? Your lawyer needs to check your articles of incorporation and shareholder agreement for share transfer restrictions. During this process, you may need to amend your articles and draft a shareholder agreement specifying ownership transfer procedures.
Lastly, do your beneficiaries have the choice to continue operating the corporation or close it down? Are they familiar with the process of converting a professional company into a normal one and an operating company into a holding company? If they're all set up in advance, then having a corporation is a great estate planning tool that can eliminate probate taxes for corporate assets and defer income taxes for return earnings.
Since corporations do not automatically end with the passing of a shareholder, it can also create generational wealth and decades-long family businesses, especially if your beneficiaries are already actively managing the company.
All right, that's all for today. We will see you in our next month's video, which will be our last one for 2025. Just a quick reminder to all our viewers and clients, our last day of work is December 19th, 2025, and we'll resume our work on January 5th, 2026. We'll see you in our next month's video.